we have already mentioned that the financial markets often are very competitive. A high degree of competition prevails in the financial markets, and the implication of this competition is the presence of the trade-off between risk and return. So this lesson is about the risk-return trade-off. If we think about the investors, think about yourself. If you invest in the financial market, in the stocks, for example, probably you will invest for the purpose of getting future return, right? It is not actually, you should not say probably. This is the rational behavior. Everyone invests in the stocks and other securities in the financial market for getting future return. But can you say what will be your return in future? Okay, so you cannot really say that I'm investing it for 15% return. The maximum you can say is I am investing for an expected return of 15%. That means your return, future return for which you are investing is actually anticipated return. Okay, why it is anticipated? I have just said that because you cannot predict it precisely. The future is unknown, future is uncertain, and it is not possible to predict the future return precisely. This is why investors invest for future anticipated return, and consequently the actual returns or realized returns are almost always deviated from the expected return. So we can say that the investments are almost always risky. The rational behavior of an investor says that all else equal, the investors will prefer investment with highest expected return. Okay, so if the situation is like this, everything is same between the two investment alternatives, and one investment alternative is giving you the highest return, so definitely you will choose the investment with highest expected return. But do you think that all else can be equal? Can all else be held equal? The answer is no. Why? Because if higher expected rate is possible without higher risk, think about risk versus return. Okay, so if all else are equal, risk must also be equal. Okay, so in that case, if higher expected return is possible without higher risk from buying an asset, then what will happen? Everyone will choose the asset with the higher expected rate of return. And what will happen? Everyone will rush to buy that asset. Okay, and when everyone rush to buy that asset, it will increase the price of that asset. Okay, and if the price of that asset increases, that will increase the cost of the investment and it will reduce the return. So this process will continue. This process will not stop. After the asset price increases slightly, still some people will be rushing to buy that asset because it is offering higher return for the same level of risk. And this process will continue until the expected return is no more than that is commensurate with the level of risk. So in a highly competitive market, you can only, as an investor, you can only anticipate a fair return relative to the assets risk. Okay, now we can think about another situation, similar situation, where if we think about the risk, if we focus on the risk, so if all else are equal, investors will normally prefer the asset with the lowest level of risk or with the lower level of risk. So again, the same question, can all else be equal? That means let us think only about the return. Is it possible that you will get a lower risk asset with the same level of return? The answer is no. Why? Because if it is possible, if a lower risk asset with the same level of return is available, then what happened? There will be a rush to buy that low risk asset because it is offering the same return but giving you the opportunity to avoid higher level of risk. So what happened? Whenever there is a rush to buy or higher demand, the price will increase, and If the price increases, that will decrease the return because your cost of investment will increase. Okay, and this will again continue until the expected return is commensurate with the risk. So these two examples, or these two arguments, actually giving us the indication that there should be a risk return trade-off in the securities market, in the financial securities market. Why? Because if you want to take higher return, probably you will have to assume higher risk, because it may not be possible to get a high return investment where risk is also low. And if this is the case, then people will rush to buy and ultimately the return will be lower. Okay, so the more is the risk, probably you will be compensated by a higher return. And if the return is lower, that will also be justified by a relatively lower level of risk. If we accept that there should be a trade-off between risk and return, now the questions come up. When you make investment decision, when you make the security selection or portfolio construction decision, you will have to compare the level of risk, compare the level of return. So what should be the way of measurement? How can you measure the risk of an asset? How can you measure the risk return of an asset? And if you want to measure whether the trade-off is justifiable or not, you again have to make the precise measurement of the quantitative trade-off between risk and return. And also you will have to consider the diversification effect. When you are investing in a number of assets rather than one single asset, you will definitely have to think about the resulting diversification benefit that will justify the diversification among several assets. So these are the things that are very important, that will come up later on when you make your portfolio construction, portfolio rebalancing, and other portfolio management decision through the security analysis. I hope that you have understood why the risk-return trade-off prevails in the market, in a highly competitive market, and also what are the possible questions that we may have to answer while making the portfolio management decisions. Thank you very much.